Every year you wait, your money gets smaller. Not because you're spending it, because you're leaving it still. That sounds harmless. It isn't. Inflation quietly reduces purchasing power every single year. A dollar today will not buy what it buys now 10 years from today. That's not opinion. That's math. And yet millions of people keep waiting for the perfect time to invest, waiting for the market to calm down, waiting until they feel more confident, waiting until they have more money. It feels responsible, but often it's one of the most expensive decisions you'll ever make. According to data from Vanguard, missing just a handful of the market's best days can dramatically reduce long-term returns. The problem is those best days often happen right after the worst ones. So if you're waiting for certainty, you're usually waiting too long. I've seen this over and over. People think risk comes from acting. Often, the bigger risk comes from not acting. Cash feels safe because it doesn't move. But while it sits there, inflation keeps working against you, quietly, consistently, relentlessly. Let's say you leave $10,000 in cash for 10 years while inflation averages 3%. That money may still say $10,000 on paper, but its real buying power is much lower. You didn't lose money in the traditional sense. You lost what that money could have become. That's opportunity cost. And it's one of the most misunderstood concepts in personal finance. Wealthy people don't just ask, what could I gain? They ask, what does it cost me to do nothing? That's a far better question. Because every financial decision has two prices. The price you pay today and the future value you give up. When you delay investing, you're not simply postponing growth. You're shrinking the power of compounding. And compounding is where real wealth is built. Forbes has called compound growth one of the most powerful forces in investing. Not because it's exciting, because it's relentless. It rewards time more than brilliance. That's why starting early matters so much. Not because you need to be perfect, but because time does most of the heavy lifting. This is where many people get confused. Patience is important, but patience does not mean inactivity. Patience means sticking with a sound strategy over time. Hesitation means delaying action because of fear. Those are not the same thing. Patience builds wealth. Hesitation delays it. The best investors understand this. They don't wait for perfect conditions. Perfect conditions never arrive. They focus on making good decisions with the information they have now. Then they let time work for them. That's the real advantage. Not predicting the market, not finding the next hot stock, simply acting early enough for compounding to matter. BlackRock, Vanguard, and nearly every major long-term investment study points to the same conclusion. Consistency beats timing, always. So the question isn't whether the market will ever feel completely safe. It won't. The real question is this: how much is waiting costing you right now? Because in investing, doing nothing is still a decision, and sometimes it's the most expensive one. The goal isn't to move fast. The goal is to stop waiting for perfect, because perfect never shows up, but opportunity does, and usually it doesn't wait around. The investors who build real wealth aren't the ones who know everything. They're the ones who understand one simple truth: time matters more than timing. And once you understand that, you stop asking, when is the perfect moment to start? You start asking the only question that really matters: why haven't I started already?